Hi, welcome back to the two-part series where we dive deeper into Meta Platform's recent earnings quarter to discover and identify whether Meta is an opportunity of a lifetime or a value trap. So as you can see in the Excel in this background, it's basically a very simple updated DCF model based on the previous earnings quarter result. So after this recent earnings quarter, I think it's timely for us to do an update and to change some of our assumptions and to really understand what the market is essentially trying to price in today's stock price where Meta is essentially trading at $99, give or take. So I think before we run through the updated model for Meta's future moving forward, I just wanted to go through one very interesting Twitter thread that I came across over the weekends, specifically about Meta stock and some of the pitfalls that we might want to be more cognizant about before going all in into Meta stock, like how I did going all in into Alibaba. Many smart value investors continue to believe in Meta, demonstrating their best qualities of patience and ability to focus on the long term. I'm not saying they are wrong, but I'd like to draw their attention to a couple of points which you might find helpful. So number one, if I show you a business with signs that its revenue has peaked, at least temporarily, and falling profit margins, moreover, capex is growing faster than sales, and free cash flow is drying up, would you want to own such a business? And if yes, what price would you pay for it? So like I alluded in the previous video, there is always a price for everything, and really this idea of capex growing faster than sales, free cash flow drying up, falling profit margins, I think you as an investor have to make the decision and the judgment saying that would this be a short-term or a long-term issue? And if you think it's a short-term issue, sure. That said, you have to plant your flag and to bake all your assumptions into your model, thinking that when Facebook will turn around and when free cash flow will start ballooning again and when all these negative financial metrics will turn for the better. I think that's an assumption that you have to make. So would you apply a valuation multiple of 2023 earnings or 2025, which could even be lower? I think I'm not going to use earnings in this case, we are using cash flow. So number two, having spent a lot of time studying behavioral finance and decision making, I have a feeling a few investors suffer from several biases that prevent them from selling losing stocks early, and I agree. So the biases are endowment effect. We value stuff we already own more than the same things if we did not own them. Number two, overconfidence. Building spreadsheets, reading 10Ks and tons of other stuff creates an impression of knowledge. But others may have access to the same or more info, hence prices may reflect this knowledge already. Besides, a lot of data is not helpful in predicting the future. So loss aversion. We feel twice as bad losing than winning the same amount. So we prefer to keep losing positions which give us psychological comfort, hoping they will once recover and we don't have to fix those losses by selling stocks. So confirmation bias plus public commitment. It is hard to change our views that we made them public, and we tend to focus only on the information that confirms our original views and disregard counter-arguments. PS, I think I'm also suffering from some of those bias in my BABA position. Likewise, I'm also balls deep in Alibaba. So planning to take a deep, fresh look at the company again over the weekend. So I consider Meta a few times, but passed each time. I think with weakening products, valuation doesn't matter. And I think this is a very timely call for myself as well, based on my Alibaba position. This is crazy. Weeble just extended their latest sign-up reward and it has never been better. So you can get up to $150 cash voucher if you fund and trade your Weeble account today. So all you have to do is to sign up for a new account with the link below and deposit at least 2,000 Singapore dollars and execute one buy trade for a stock or ETF and one option. And that's a whooping 10.5% ROI on your initial capital. So for those of you who have been sitting on the sidelines for some time now, I think this is the sign to get yourself motivated. So Weeble prides itself on zero commission trading. So let's stop paying commissions and use them to buy more Alibaba. So if you need another reason to sign up for Weeble today, they are also giving out attractive referral rewards if you get your friends to sign up using your own referral code. But of course, you should do so with mine first. Wink wink. Don't let this 10.5% ROI slip away so easily. Link will be in the description. Thank you Weeble for sponsoring this video. So now back to Meta platforms. Let's try to update our model and see what the market is essentially trying to price into the stock today. Because like the Twitter chat suggested earlier, building fanciful models on Excel doesn't mean that you have an edge over the market, because most of these so-called expectations are already priced into the stock. Firstly, we have to understand that since they have already bought back quite a great deal amount of shares, so the total outstanding shares for Meta platforms is sitting around 2.68 billion today. So as of now, you can see that I've made several adjustments in terms of our capex and also our revenue guidance, because we have greater clarity in terms of how Meta Platforms has guided for all the different analysts out there. Firstly, you can see that instead of a capex growth of around 60% to 29 billion, because they did provide a guidance, a very loose projections of around 29 to 32 billion. But based on this earnings quarter, they did say that it's a lot closer to 31 to 32 billion. So in the name of conservatism, they're going to grow it to 32 billion. So that's actually a 75% bump in capex. And of course, subsequently in 2023, they also provided a guidance between 34 to 39 billion. So let's take the middle point, which is 37 billion. And that's a 15% growth in capex. And subsequently, I just flatline it to a 10% growth in capex. And for that discussion on Reality Labs and how much they're going to burn, I'll leave it to the later part of this video. Now, in terms of projections from cash for operations, initially I thought maybe a 6% growth in cash from operations is considered conservative, but evidently not. We can see that if you were to just draw conclusions from the first 3 quarters of how Facebook or Meta has did, you can see that in Q1 they did around 14 billion cash from operations, 12.1 and 9.6 billion. So in Q4, actually they did guide a revenue of around 30 to 31 billion. So actually if you look at Q3, it was around 36 to 40% that flow into the cash from operations. So if you were to just take 40%, just to be slightly optimistic, and you just multiply it by 31 billion, that gives us around 12.4 billion. And if you sum all of them together, that will give us around 48 billion. And a negative 20%, I think just to round the number up, let's assume that cash from operations actually collapsed to 46 billion, and that's a negative 20% year-on-year cash from operations. And moving forward, I think I really just wanted to try to understand what the market is trying to price it today. So the share price today is around $99 or give or take 100. And based on the current streamlined projections of how they're going to grow cash flow, because they did say that Reels monetization currently has been pretty lackluster and they require around the next 12 to 18 months in order to drive up monetization. So let's assume that in 2024, then they are able to drive back up their monetization rate and it will flow down to the operating cash flow. And that is when they can even remotely come back closer to what they've done in 2021 in terms of operating cash flow. And based on these projections, 10% in 2023, because they might kind of recover from the strengthening of USD, and maybe the global headwinds might not be as taxing on the digital advertising industry. Let's say they recover by 10%, 25% and up into 10% into 2026 again. And I'll just apply a long-term free cash flow multiple of 15 and a discount rate of 15%. That is where you get today's pricing. So do you agree or do you disagree with these current projections? Personally, I disagree with current projections. I think it's up to you to decide. I'm just trying to massage the numbers in a way where it's kind of reflecting today's market cap and essentially what the market is trying to expect of Facebook in the coming quarters or coming years ahead. So from this projection, of course, I'm being conservative. Some of you might say that, hey, a long-term free cash flow multiple of 15 is essentially discounting Facebook into oblivion, because I think commanding around even a 20 free cash flow multiple is a lot better, or even some of you might argue 25. And using a weighted average cost of capital or a discount rate of 15% is too crude for Facebook, because if you just do a quick Google search, I think Facebook's discount rate is probably in the north of 8 to 10%. Using 15% is just me being a little bit more conservative, especially when there's this huge uncertainty overhanging onto these Reality Labs and capex investment. So I think just a last point before I end off this video, I think I really like this short clip, I'll be playing it soon, where Chamath was talking about when a particular big tech company or any company of that sort that creates and plow in a lot of R&D to many of all these consumer-facing tech products, regardless is it the iPhone, Google search, or even this so-called metaverse, omniverse, or mixed reality, augmented reality, whatever they like to call it, it has to go through this sort of iteration cycles. That's it. Mark Zuckerberg now is plowing in billions and billions of dollars per quarter into this metaverse reality lab segment, where God knows whatever that's going to come out from this investment and what the ROI would be. So I think this is a very huge question mark that many potential investors cannot square away, which is why they punish the stock itself. And I'll just play a short clip here to let you understand the scale and the extent of this reality labs investment or expenditure.
Here's what's going on. If you look at the light purple bar, Facebook in the last 2 years have spent $25 billion on reality labs. And they said that they're going to spend, meaningfully more in 2023 and then sustain that investment for a while. So if you do a little bit of math, if they spend, they spend around $4 billion a quarter right now, so $16 billion a year. That'll go to 25 billion in 2023, and then they'll sustain that. What that means is that over this, 12 or 13 year life of Reality Labs as we've seen it, these guys will have spent $250 billion. And what I did here was I just wanted to understand.
Hilarious.
I wanted to understand $250 billion in the context of other major leaps in humanity. So at the left is what Apple spent in its entirety. By the way, these are all inflation adjusted dollars for today. Apple spent $3.6 billion to create the first iPhone. And what they did was they said every subsequent version of the iPhone would only be funded from the cash flow and profits of the generation before it, right? So they used consumer demand as their guiding principle. So it was a very incremental approach. iPhone 1, iPhone 2, and now we're at iPhone 14 or whatever, 13. But the point is, it took $3.6 billion to get that juggernaut off the ground. The Manhattan Project will cost $23 billion in today's dollars to create the atomic bomb. Tesla, in its entire life, spent $25 billion to get to free cash flow profitability. And they took this incremental approach as well. We'll create the coupe, the Roadster, then the Model S, then the Model X. They iterated their way. They used customer demand and all of that revenue to fund future growth. The cum spend on Tesla was $25 billion. Boeing spent $32. Google and other bets has spent $40. The only thing that I could find in history that is comparable to what Meta has basically said they're going to spend is the entire Apollo program, which cost in today's dollars $250 billion as well.
Now, personally for me, I'm not extremely bullish or bearish on Meta platforms today. At least for now, I'm standing on the fence and I'm extremely neutral on the position. Sure, I do have exposure in Meta platforms and it makes up around 3% of my portfolio. I don't think it's a very good long-term investment hold if you don't believe in the metaverse or you don't believe in Mark Zuckerberg. I think those are the two bottom lines. But that said, I think in terms of the current projection, this is what the market is probably expecting. You can agree, you can seek to disagree. I think it's up for you to decide as an investor yourself. So with that, I'll see you in the next video, but more importantly, I will see you on the moon. Goodbye!